Hi. Hi, everyone. Thanks for coming out. I think he's going to be adjusting the mic a little bit in the beginning, but we're really excited today to be up here talking to you about the future of money. So first, let me introduce ourselves. My name is Adi. I'm here with Parth, and together we're the best-selling authors of the book Swipe to Unlock. It's a book on technology and business strategy that has sold over tens of thousands of copies internationally and was recently awarded the bronze medal by the North American Book Awards. I'm currently a product manager at Microsoft, and I work on Azure Cloud Growth. And previous to that, I was head of product at Spear, a news analytics startup in the States, and I started my own company called Bell Applications.
Hi everyone, my name is Parth Detroja, and I'm a product manager at Facebook. I lead our music ranking and personalization efforts around music sharing. Previous to Facebook, I worked at Microsoft, Amazon, IBM, and a few other tech companies. What really got me interested in blockchain was I used to work on the payments team at Facebook, creating payments product for emerging markets. And so what I realized when I was working on payments was that there's a lot of confusion as well as interest on blockchain, but not that many great resources around that. So Adi and I are actually writing a book right now called Bubble or Revolution, which comes out next month, which is our analysis on the future of blockchain, cryptocurrency, and decentralized technologies. Writing this book, we interviewed over 100 thought leaders in the space, from authors to venture capitalists to startup founders. And we're really excited to share some of our key learnings with you here today. So let's get right into it. So, what is money? If you go on Google right now and search money is, you'll find results from money is the root of all evil to money is power and everything in between. But really, what is money? This isn't a new question. This is a question that Aristotle asked himself over 2,000 years ago. And so back in Aristotle's time, when bartering remained core, what Aristotle found is if you had an item and you wanted to exchange it with somebody else, but they didn't want your item, you had to go find a third person to serve as an intermediary to facilitate that exchange of goods. But that's not an efficient way of doing commerce. And so Aristotle defined 4 principles for creating what is considered money. And these 4 principles were durability, divisibility, portability, and intrinsic value. And so let's try applying some of these principles. So if you look at precious metals like gold or silver, this clearly meets all 4 of these principles. But then if you go into something like modern fiat money, it's not so much durable if you're talking about the paper money. It's not intrinsically valuable because it's dependent on the value of that currency itself. If you look at a stock index like the S&P 500, which is the top 500 stocks in the US, that's not portable because you can't easily move that the value of those stocks across to facilitate commerce. And cryptocurrencies are very similar to fiat currency today in that it's not intrinsically valuable, but it is more durable than traditional fiat currency. So this is a quote by the CEO of JP Morgan in 2017 when the value of Bitcoin was starting to take off. Bitcoin is a fraud worse than tulip bulbs. It will eventually blow up. And so I guess what Jamie is trying to say here is that at the time, Bitcoin was purely a speculative asset that everyone was buying into because the value kept going up and they wanted to get in on it. The CEO of Goldman Sachs had a little bit more optimistic view. He said, still thinking about Bitcoin, no conclusion, not endorsing, not rejecting. Just remember that people were also skeptical when paper money displaced gold. So before we dive into this, let's give a bit of background on the past of money before we get into the future. So in the United States from 1837 to 1862, there was something known as the free banking era. And in the free banking era, there was no established national currencies. States were allowed to charter their own banks. And what this led to is there were tons of banks. They didn't have long life cycles. they all had varying reserve ratios, and so a lot of these banks were printing much more money than they should have. The average life cycle of these banks was under 5 years. People didn't have trust in these banks. They weren't durable, they didn't stay around, and you didn't want your life savings in them. So the government stepped in 1863 with the National Bank Act, which established the national currency of the US dollar, and it also created a standard reserve ratio of, if you print this much money, you need to have this much gold or silver in your safes. And so what this did is it brought trust back to the banks, and it brought stability. And so what we're experiencing today is sort of the Wild West of cryptocurrencies, similar to the free banking era, where it's so easy to create your own cryptocurrency. It's so easy to create your own blockchain off Ethereum or these other platforms. And so there's not that much trust, because these startups, a lot of these crypto startups, have short life cycles. It's not something, given the volatility, that you want to store the bulk of your assets in at this time. But cryptocurrency does have immense potential from a technological perspective. Like, imagine you want to send $10,000 to your friend in Indonesia right now. I called my bank about a week ago to ask what it would cost and how long it would take. They said ballpark it'll cost around $400, and they'll get the money there in 10 to 14 business days. They can't give me an exact price, nor can they give me the exact time frame. If I instead go to UPS and mail $10,000 cash and insure it for $10,000, I can get that done for about $150, and I can have tracking every step of the way to know exactly where my money is and exactly when it's going to arrive. Bitcoin offers a lot of potential in this regard, in that it can deliver money much faster in a traceable way, so I can know exactly when, do it much faster, and at much lower fees. No matter how much money I'm trying to move, I could do it, like if it's a large amount internationally, it makes more sense to use a cryptocurrency.
And so, given that there's a real use case for cryptocurrency, why haven't a lot of governments already adopted it? So if you look at a country like Venezuela, which has, the Venezuelan bolivar has been inflated 1.3 million% in recent times. It definitely makes sense for a country like that to adopt Bitcoin or another cryptocurrency, because it's objectively more stable than its own currency. But even if you look at a country like Turkey, where the lira has, in the last 18 months, Turkey has faced a lot of economic turmoil, so the lira has been inflated over 40%. Even in a country like that, it doesn't make sense to adopt Bitcoin, because the volatility that the lira sees over a year is equivalent to the volatility that some of these cryptocurrencies face in a matter of a week or a month. And so, for some of these stable countries, when people park their life savings into a currency, they look for a store of value. And so, how do we see these big countries that have relatively stable currencies like the euro or the US dollar, how do we see them adopting blockchain? So, our first prediction is that countries will start tokenizing the national currencies that they actually have right now. And so, as many of you know, majority of payments are moving towards the digital form. But what you may not know is that the bank account balance that you see when you check your app or you go online to the bank's website isn't actually stored in physical hard cash by that bank. What's actually happening is that money is moving from one bank's database to another account in another bank's database. And 80% of these transactions and 95% of all ATM transactions use this programming language called COBOL, which was invented in the 1980s, which uses legacy hardware and is severely outdated. And so when governments and financial institutions modernize and tokenize their currencies, they'll be upgraded to a more modern financial infrastructure, which will not only bring security and a lot of the other technological advances that blockchain brings with it, but it'll bring the ability to audit your money and see the inflow and outflows, which will influence monetary and fiscal policies that the government can't currently do. And this is similar to how back in the 1900s, big banks around the world, especially in the US, used $100,000 paper money. This money was never to be used by people like us for daily, everyday transactions. It was meant to be used to move large sums of money from one bank to another bank cheaply. And the back-end efficiencies that this brought trickled down to the end customers. They saw faster times in moving their money and getting withdrawals. They saw cheaper costs. And that's the same thing that will happen when governments start tokenizing their currencies. And our main prediction is that we think that China is going to be the first world power to go out there and tokenize their national currency, the yuan. Now, let's take a step back. In November of 2015, the IMF, the International Monetary Fund, decided to make the yuan a global reserve currency. And there's only 4 other currencies right now, along with the yuan, that are global reserve currencies. They're the US dollar, the British pound, the euro, and the Japanese yen. And so even though at the time, and even currently, the yuan represents 1% of international transactions and 2% of all reserve currency in the world, it represents 27% of GDP growth in 2018. And so because it's stimulating the economy, China is investing heavily, the People's Bank of China is investing heavily in making this technology, digital payment technology, more advanced. They filed 78 patents in the last 2 years, 44 of which are all blockchain related. And so the reason why Chinese yuan hasn't been adopted vastly yet is because China is not trustworthy in the eyes of many foreign investors. China regularly devalues their currency. They go out there and by devaluing their currency, what ends up happening is foreign currencies become more powerful, which stimulates exporting, which pumps their GDP. And investors know this. But imagine a world where China adopts blockchain. What they could do is they could have this perceived transparency and auditability in their currency system and in their economy that would allow foreign capital to come in and help them achieve their goal of increasing adoption as they start their newfound journey as a global reserve currency. And so, in summary, we think that this tremendous impact that blockchain can have when it's solving problems, when it's automating these inefficient, complex systems. But when you hear about these solutions that are decentralizing existing products and services and just putting them on the blockchain, we're extremely skeptical about those. Because blockchain is extremely efficient at solving a very specific technical problem. When you have a group of parties that need to trust each other, move large amounts of resources or high-value assets or money between each other for low transaction costs, blockchain is the ultimate technology you can use. But it's not a one-trick pony that will solve all your problems. The people problems, regulations, logistics, adoption issues that every other technology faces also apply to blockchain. And so even though cryptocurrencies and blockchain were invented as a way to disrupt power structures like the government and banks and institutions, we think that these power structures will go out there, figure out what parts of their business or economy they can use and adopt blockchain, improve these back-end services, and then pass along these benefits to us, the people. Thank you. My name is Adi. This is Parth Detroja. We're the best-selling authors of Swipe to Unlock. Thank you. Yeah, right after this.
This one should be next to him. This one.
Okay, can everybody hear me? Okay, sounds good. All right, let's get started. My name is Max Kantelia, and I'm one of the founders of a public blockchain protocol called Zilliqa. For those of you that don't know about Zilliqa, it's actually the world's first public blockchain protocol to use a technique called sharding that achieves very, very high throughput in the thousands of transactions per second. We've also been daring enough to build our own smart contract language, which is secure by design. It means that we can formally verify any code that is created before it goes out onto a public network. My background is that I'm a lifelong entrepreneur and investor around the financial services and deep technology spaces. And so what I want to talk to you about this afternoon is really a set of thoughts around where blockchain technology is heading today when we look at financial services and also other industry sectors which are going to intersect with financial services very, very closely. So firstly, let's start with money. I think it's well publicized already that over the last 5 or 6 years, a huge amount of venture capital is going into blockchain ventures. And if you look at the last couple of years in particular, you'll see that there's exponential growth in the level of investment that VCs are making into blockchain technology companies. This is a very important fact. If we look at fintech globally today, last year for the first time, investment went above the $100 billion mark. And actually, there's data that suggests that 20% of that is actually going into blockchain-related ventures, which is huge. I really like what KPMG have to say about the fact that 2019 is the year when companies start to build very specific products and services around blockchain. This, again, I think is an important fact to think about. That's all good news, but there's some really horrifying news too. So Forrester last year reported, and I can tell you from everything I've seen over the last 4 or 5 years, that this number might be underestimated, that 90% of proof of concept projects, particularly I would say in financial services, don't go anywhere near deployment. I actually call it the graveyard of POCs, and it's particularly prevalent in financial services today. So why is that then? Lots of money coming into this space. Why aren't there more companies in financial services using blockchain beyond a POC? Well, I have 3 things that I want to proffer today. Firstly, we see a lot of companies trying to use a blockchain when all they actually need is a database. It's quite shocking. Secondly, in financial services, we all know it's a little bit of a Me Too industry, and keeping up with the Joneses, the bank next door, is very, very important because the CEO likes to go out at annual statement time and talk about the fact that they're using a trendy new technology. The third reason, which is an important one, especially when people have valid use cases, is that the technology itself lacks scalability and security. And actually, it's really not enterprise ready or corporate ready in most instances today. So I'd like to show you a screen which, actually, you're probably all too young to remember this, but this is a screenshot of something called the Netscape browser. It's 1993. And the reason why I show you this is because that's about where we're at with blockchain technology today. It's 1993 and Google hasn't appeared on the scene yet. So it's still a very early stage technology, and we need to give it a little bit of time. All technologies run in life cycles. And when you look at the blockchain life cycle, it's no different to anything else. But for me, what's very, very interesting is that McKinsey calls it the pioneering stage. We're actually in this stage where experimentation and pioneering is going on. And that probably explains why so much venture capital is coming into the space. And this is an exciting moment because it's where brave, maybe sometimes foolish entrepreneurs such as myself come into this space without really customers that are there to validate the technology. but then they come into the marketplace and start to build things that people might just use. So then, in our experience over the last 4 or 5 years of talking to people about this thing called blockchain, when do you actually really need one? So I can tell you that we can reduce many of the conversations we have with people about using blockchain to this very, very simple flowchart here. Most of the time, people realize or don't realize that actually they don't need a blockchain to serve a particular use case. And if they do need a blockchain, there are now very many different flavors out there of things that you could be doing. So it's very important to think about why you want to actually apply a blockchain to solve a problem in financial services. So then over the last few years at Zilliqa, which is just coming up to 2 years of age, we have actually discerned some real use cases. And those use cases are both in financial services and in other industry sectors where actually payment and financial services become very, very important components. So let me share some of those thoughts with you. So at Zilliqa, we have actually over the last few years focused on building big industry partnerships to prove that there are big valid use cases for this technology. The first one I'd like to draw your attention to, only because it's just been made public a few weeks ago, is that for the last 6 months, we've been working with a company called Mindshare. If you don't know who Mindshare are, look them up. They're part of WPP. They turn over 30 billion a year, and they're one of the world's biggest digital advertising agencies. So what we've been doing with Mindshare is something really very important. We've used a blockchain and a smart contract layer to basically create an end-to-end reconciliation for a digital advertising supply chain, which, as some of you may know, is actually a very complex supply chain made up of a lot of different actors who don't necessarily trust each other. Just 2 weeks ago, we published some startling results, and actually the name of the customer that Mindshare used on this project, it was actually Pepsi Cola. Pepsi Cola derived nearly 30% cost efficiency by using a blockchain in a programmatic advertising supply chain. Well, what does that actually mean? It means that an advertiser now only pays for a viewable an advertisement or an impression if it's viewable, and secondly, hasn't been tainted by some kind of fraudulent activity. This project has just started, but we see huge potential for how this could change the entire digital advertising industry, from making advertising more contextual to tackling fake news. We see huge potential for this. And payments becomes a very important layer in this too. Another industry which some of you may be familiar with is gaming. I know it's sort of at the very much at the heart of some of the things that happens in Malta, for example. But I'm not a gamer, but boy, oh boy, have I been startled by how blockchain can really change the way that games can bring huge advantages to the player. For example, making applications, making payments in application, being able to use accessories across different games, and also cutting out some of the secondary market fraud that exists in the gaming world. So then on to core financial services. As I say, I've been an entrepreneur around this space for a long time, and it still startles me that it takes 3 days for a securities transaction to be settled and paid for. And this room still evokes memories of what banks, I think, it looked like not so long ago. Last year, we were invited by the MAS, which is Singapore's regulator, to actually look at how we could take this problem and solve it. And we did. We used multiple blockchains, including Zilliqa, to do different things. One, for example, might transfer the security. The other might make the payment. And with a smart contract layer in between, we were able to show that we can do real-time clearing and settlement of any security, and we can do that in straight away at ridiculously low cost. So what's coming next then? Well, I'm sure in Malta over the last 24 hours and over the next 24 hours, a lot of you are going to be talking about this thing called securities tokenization. I'm a believer. I think that this is going to change the way that people raise capital for private companies, but I think it's also going to change the way that the security service industry automates a lot of manual labor. We've actually announced just a few months ago a partnership, and we've taken a stake in a new exchange called HG Exchange, which I think is going to become the first STO exchange for Southeast Asia. However, let me tell you the bad news. The bad news is that this is in many people's eyes, it's still a pipe dream. You know, there's a lot of work to be done by the world's top regulators in making this happen. There's a lot of work to be done around the process, and actually still a huge amount of work to be done on the underlying technology. So I don't think this is happening anytime soon. My best hope is it's sort of 2 to 3 years away. But when the floodgates do happen, I think it's going to change and disrupt the way, certainly, that private equity works today. So why, when you do actually find a use case in financial services or any other sector, what do I think you need to consider? Well, I think we need high throughput blockchains, which is why we've spent so much time and burnt so many brilliant brains on building Zilliqa. And it's not just because your application needs high throughput. It's because we've got to cut out these traffic jams in the system. That it's just not good enough. So today with Zilliqa, we're able to process thousands of transactions on-chain, and that was one of the key things that we wanted to do with it. Secondly, security. This is a disaster, and we hear every week, every month, about yet another hack that results in assets, crypto assets being stolen or frozen. We've actually built our own smart contract language with formal verification, because a lot of hacks do happen because a coder makes an inadvertent programming error that then gets exploited by a hacker. This has to stop. Finally, of course, the economics of using blockchain. If it isn't economically efficient, in the last talk, there was discussion about how much money banks charge to make transfers, then of course people aren't going to use this technology. And again, I'm very proud to say that for the cost of making one Bitcoin transfer, we can actually make 40,000 ZIL transfers at this point in time. So finally, to round up then, what do I think is going to happen in the next year or so? Well, I think not just Zilliqa, but everyone in this industry needs to work on usability. If we're going to make these things enterprise-ready and corporate-ready, usability is very important. Interoperability between different sorts of blockchains, very, very important. We're not going to end up with just one. That's not going to happen. And privacy is a major, major issue now, given the regulation that is gripping the planet today. And finally, more and better security, I think, is absolutely vital if we're going to take this mainstream. Thank you very much for listening to me.
Hello together. So I don't just have a similar topic, I also have a pretty similar name, because my name is also Max. Where's the presenter? Okay, so I'm going to talk about STOs in a very practical way, because first of all, who of you is somehow involved in STOs or in security tokenization? Okay, because what I've been seeing over the years is that last year everybody was speaking about ICOs and everybody was launching their own token, and we have somehow moved back from the very technical aspects that we had maybe in 2013 when I entered the space. to a very business-centric approach in 2017 and 18 with ICOs, and now it seems like ICOs were the bad thing, and now we have STOs that are regulated and they are much better. That's how it's often proclaimed. However, I want to take it a bit more rational and take it to a rational approach in the way of when does it make sense to go for an STO and how do I get started? Because we have this big vision of new capital markets. We have security tokenization, which leads to higher liquidity, to better secondary markets and all that stuff. But what I see on the conferences is that we have a lot of vision, but a lack of action. And this is the main problem I see. So I want to keep it quite practical here and want to speak of the perspective of a startup who wants to go for an STO. So the first question is, do I really need an STO? So the advantages of STOs, they've been discussed previously in the other presentations. They are definitely there. We have better secondary markets. We have probably a more efficient process when we compare to IPOs. We have a more efficient clearing and settlement when it comes to transactions and many, many other benefits. But the question is, do we really need an STO? Because in many cases, it actually makes sense to settle your business on classical financial ways. Because right now we have a lot of uncertainty, especially when it comes to regulation. It's pretty unclear in most of the jurisdictions how STOs are treated or how tokens fit in the regulatory framework. There are a few locations like Malta, Liechtenstein, Switzerland, Singapore, Japan that are quite positive about tokens, but we have many that are negative, and the most of them, they don't have any opinions. So it can happen to you that you do something today and you get fined for it tomorrow. And that's a big issue. So first of all, just be sure that the STO is the right way for you to go, because there are many traditional ways of finance that could actually be more efficient in your case. So second, it's important to define what's your real goal. Is it your goal just a monetary one? Do you just want to collect money, or do you see any other benefits? Because this is really important, because the purpose of an STO that most people have in mind is actually to collect money from retail investors, but retail investors usually do not give you any strategic advantage. If you have larger investors with a big network, with a big network of other companies that they can connect you to and they can integrate your solution into, you have a strategic advantage. And this advantage is not being given if you go to retail investors through an STO. So this is one of the most important questions you should ask at the beginning. What is my goal? Is it just to collect dump money, or do I need smart money? Because if I need smart money, it might make sense to not go for an STO and instead collect money in traditional ways before. So step number 3 is defining the investor groups. So assuming that we want to go for an STO and we define that the STO is the way to go, we need to be sure about what do we really want to target in terms of the people who invest in our project. So first of all, we have retail investors and we have professional investors, as I just mentioned, in terms of which value do they bring into the project. Are they just giving in money, or are they giving in network, knowledge, people, and connections? Second, which regional targets are we targeting? Because this is really important when it comes to regulation. Depending on which people we are targeting from which country, we might face different jurisdictions and different requirements coming up with that. And last of all, also socio-cultural, because the people we're targeting at the end of the day are just people at the end, and they have different attitudes, different values, and we need to adjust our marketing strategy according to that. So it's completely different to sell a token in Europe than it might be in Asia or in the US. Step number 4, defining the target market and the jurisdiction to ensure compliance. This is totally bound to the previous aspect about which investor you want to target, from which country he is, because the jurisdiction is important in 2 ways. First of all, you have the jurisdiction where your company is based, so where you operate out of, and second, you have the jurisdiction of the investors, where they're coming from. So as you can see, it's really important to do these steps in the right order. It's not that these steps are complicated, but if you haven't done step number 1 or step number 2, you will have a large issue in number 4 or 5 at least, because if you haven't defined whom you want to target, you will have issues in the compliance, or you will waste a lot of money by being compliant in jurisdictions that are actually not relevant for you. So step number 4, taking into account everything that we have defined previously, is then about where to incorporate and where to sell the tokens to. And step number 5 is actually iterative fundraising. It's oftentimes simplified to fundraising, but what's important in my point is that we do not just do fundraising as one activity, because it's actually an activity you can divide into multiple steps. So you might have strategic investors at the beginning who help you build the structure, build the team, build the product, and then later on you can collect retail investors that have other strategic benefits. So the retail investor could actually be your potential customer in the future. So by selling this token, you actually have a benefit in terms of customer acquisition costs. And every different investor brings a different advantage, both monetarily as well as non-monetarily. So this is a very quick overview, and apparently I cannot dive into detail here into 5 minutes. But I have prepared something for you because, as I told you, the purpose of my keynote is to just give you a very brief way on how to get started. It's not about the vision, it's about how to do it. And this is what I've been working on the last 6 months. And today is the first time I'm going to announce my new book, Assets on Blockchain, because this is what I've collected throughout the last 1.5 years, but I've been writing this book for 6 months, and it combines all the knowledge that you need for token offerings. And as I said, my purpose is not to say how great and how awesome and how amazing and how advantaged token offerings are. My purpose is to make them applicable and to make them usable for the few projects that they're actually valuable for, and not just put them on everything. So thank you very much.
Hello, so now we're going to have a panel, and I'd like to kindly ask Paul, Jean-Michel is here, Sean, and Stefan. Yes, thank you. Okay, until the others arrive, can I ask you guys to introduce yourself very quickly so that we can go to the panel then?
Okay,
Hello.
sure. So I'm Stefan Beyer. I'm the CEO of Cryptronics. We are a spin-off of a large cybersecurity company, and we focus mainly on smart contract security, but also full stack security auditing.
Thank you. Jean-Michel?
I am Jean-Michel Azzopardi. I run a cybersecurity company called Kralanx. We focus on delivering hardcore cybersecurity solutions to the blockchain space.
Awesome. Paul?
Hi, everybody. Paul here. I'm the head of product at Keyless. We do decentralized authentication, which functionally means key management by way of biometrics. So we touch on self-custody, but today, I guess, also exchange custody.
Awesome. Hello, Sean.
Hello.
Thank you. If you can give a quick introduction about yourself so we can get cracking.
Yeah, my name is Salloux. I'm the CEO. Excuse me.
Hand him the mic, please.
I'm the COO of Banks. We're a white label banking platform that issues Visa debit cards and white label wallets for crypto-friendly communities. My background is I was at Gemalto and did some of the first e-money wallets back in 1999 for Mondex and MasterCard in Korea.
Awesome.
And I acquired most of the public key infrastructure, all the keys for all the crypto stuff. It's mostly based on Gemalto hardware security modules, which I helped them acquire in the late 99.
Very good. There are local providers in Malta which use Gemalto as well.
Yes, it's probably the biggest one in the world.
Awesome. So, this panel is about security, right? And I want to ask a few questions on how and why actually crypto exchanges and smart contracts get hacked, and when will the problems end, right? So if I can start with you, Jean-Michel.
Sure.
Generally, right, how is a crypto exchange hacked? Where is its Achilles heel?
So you've got phishing, which would probably be the most prominent point of initiation. Then you've got insider threats, which are another big issue, right? So if you
And when you say insider threats, it means what?
I mean, you work at an exchange. I'm a hacker. I come up to you and I say, "Hey, man, I'm gonna hack your exchange. I want your help. I'll give you 25 million for your assistance.
All
You're
right.
probably going to say yes.
Fair enough.
Or at least a few of you might. You know
And
what I
that
mean?
would mean, therefore, that insider would do what? Would share private keys?
It could literally be something as simple as plugging a USB device into a local network.
Okay.
And then you have your Quadriga CXs of the world, which I think everyone kind of knows the story there, no?
All right.
The founder dies, and he's the only guy with access. Dies, exactly.
And he runs away with the money. Paul, I've seen you holding the mic. Maybe you want to add something?
Yeah, I think what he's pointing on there is it's really still a matter of human error, even at the exchange level. So I don't care if you have multi-signature contracts, which are an advantage given some exchanges. One guy might be holding all of the assets, all right, in one wallet. So from this point, in fact, like if you trick the human or you bribe the human, or the human just wants to walk away with your money, in a lot of cases that can happen.
But how do you actually, therefore, okay, say you want to hack an exchange, right? So let's do a real life scenario. You want to hack an exchange, the exchange holds its money, a small portion of its money in hot wallets, and say it's almost impossible to get access to the cold wallet, so you want to attack the hot wallets, right? And the hot wallets are multi-signature wallets, right? So what is the textbook approach to handle this? Maybe Stefan can...
Yeah, well, if it's a multi-signature wallet, the textbook approach is to get enough signatures, right? So you need to get access to these private keys. But usually these wallets, the keys of these wallets, they have to be exposed somehow because an exchange needs to provide instant liquidity. So in this case, the keys are sort of programmed into the system somehow. So there's at least a percentage of the funds that are instantly accessible by some programmatical way of signing a transaction. And then there's, to get to that stage, there are a lot of attack points. The whole software stack, from the simple web interfaces to faulty databases, everything. But as has already been said, the weakest point is certainly the human. So phishing attacks and insider attacks, they are probably the most likely ways of getting these keys.
So if you can explain also to the audience, right, in simpler terms, right? So you have a human who you want to take advantage of, right? Besides coercion, right? How do you actually get access to the hot wallet?
Well, you probably trick them to install some malware on their personal computer.
All right.
Via phishing, you send them an email that looks to come from someone they work with, and these people are very clever. They're usually very professional, organized groups, and they do social engineering. They really study an individual and find out what if they are part of some sports club, and they might pose as the sports club, whatever, and they get passwords and access to their personal computer, and then somehow to the key, and that might be attacks that take place over a number of weeks, and they're obviously very lucrative targets. So
all right, very good. Sean, I want to ask you, right? So from a procedures and policies point of view, what do companies ought to do to actually avoid problems like this?
So what I see from an exchange level, there's a lot of procedures and policies. So if you look at how the banks have been regulating high-frequency trading desks for derivatives tradings, offshore derivatives tradings is probably a good example. So the person, our compliance person did that. And so they have a book it's about that thick on how to handle every procedure from who gets into the door to the credit checks to the reference checks till they look at the bank details of all their employees. They don't if they outsource some of the software development.
Okay.
And what we see, a lot of the exchanges don't, they might have the manual, but they're not following the procedures. And if you look at most of the biggest hacks from, the big ones in Japan early on to the latest ones, last week.
And Binance, right?
Yeah, from Binance, you'll see that it's mostly, they either don't have the procedures in place or they don't follow the procedures, right? But if you're at a bank, you lose your license like that. And if you look at some of the problems a Wirex or a Revolut have had on their KYC, it's because they didn't follow procedures, and they're in the process of losing their banking licenses.
Okay. Very
So
good.
in unregulated exchanges, there's not that pressure from the government says, okay, if you don't follow the procedures, you lose your license.
Okay. And so we've covered exchanges, right, roughly. So what about smart contracts? Because so much funds are stored on smart contracts, right? Maybe, Jean-Michel, could you So how do you hack a smart contract? There's a code error, right, which you try to take advantage of. Is it right? And how do you avoid that from happening from a regulatory point of view or from a provider point of view? As in, you have built the smart contract and you want to avoid that happening.
So essentially, it's about good security hygiene. So security vulnerabilities are discovered on a daily basis and are recorded and reported on a daily basis. The problem is that from a compliance perspective, exchanges and pretty much most traditional industries run a pen test once every year. Right now, if you look at 2017 specifically, there were 20,000 new vulnerabilities which were discovered. So between the time that the pen test has ended and the second pen test, there is a ridiculous amount of vulnerabilities being exposed. So the problem is that exchanges and most companies in general really aren't doing enough in that time to be able to secure themselves against those new vulnerabilities. If you take smart contracts, gas flooding, for example, would be one vulnerability which you could use. So you could say.
And what is that?
It's basically manipulating the amount of gas either required to make a transaction or the amount of gas available to make a transaction. So you would essentially run a transaction, and that would remain in limbo because there isn't enough gas to affect a transaction, which could eventually have quite serious implications on the entire chain.
Okay. Paul, maybe you have some points on this as well?
Yeah, I guess there's some additional. So if you're looking at the underlying assets that these exchanges are trading, for example, there's updates to the blockchains themselves. So if we look at Ethereum, for example, in Constantinople, the update, huge security bug found before it was pushed. But anything that's built in there, the exchange or whoever's trading it is going to see that feature of security flaw. And that can be exploited. So
I see, all right.
This has definitely been taken advantage of before. And in some cases, they don't have the expertise to actually check for all the bugs.
One other thing I think might be interesting in pointing out is also when you look at smart contracts, a lot of lay people and investors think, it's a smart contract, it's a blockchain, it has to be secure. But it's just, if you take away the word smart contract and say code, anybody who's developed codes knows there are bugs and flaws. And I see two ends of the spectrum where banks and things will do everything in-house and be very secure, and then there's open source. So when you look at a smart contract, just because they say, it's a smart contract, who wrote it?
It's not necessarily so smart.
Yeah, where were the developers? Do you know the names of the developers? Has the smart contract been penetration testing? Who did the penetration testing? Was it KPMG, or was it a small company, guys? So when you're looking at, just because it's blockchain and it's crypto, you still have to do all the penetration testing. You have to do all the security things as a normal if it was a banking contract. And there's pluses and minuses to everything. I've heard, open contracts where it's open source code. A lot of people are looking at it, which is good. You can catch a lot of bugs, but at the same way, a lot of people are looking at it.
And know about the problem.
And if one person finds a flaw, it's easy, it's hard to track that person. Where it's closed, not that many people are looking at it, and that's good and bad, because with one bad apple, they can steal a whole lot of stuff.
So you make a good point, John. So, Stefan, if you see a smart contract, right, what makes you trust it or not trust it? What are the actions? So say there's an ICO or anything, right, which asks you to send money to that smart contract. What is the thought process you go through before actually making the transfer to the smart contract, before trusting that smart contract?
Yeah, well, in my case, that's a bit different because I'm actually a smart contract auditor, so I understand the code.
All right, which actually you can share a huge insight, right?
But obviously, not everyone can do that. So what has already been said, it's to look at who's audited the code and how it's been audited. And obviously,
but if I can stop you, right? So fine, there's an audit, a penetration testing, but it's not done all the time, I would imagine. It would be done once a year, right? And hackers will continue, and the penetration testing will take maybe a week, 2 weeks, but a hacker would spend months probably, right, to actually manage to hack that smart contract.
Yes, exactly. But smart contracts are relatively small compared to the overall platform.
Okay.
And a smart contract, when it's audited, there's a number of steps to look at, and there are best practices and there are recommendations out there. And the thing with smart contracts is once they're deployed, you usually cannot fix them. So this process is really thorough compared to the other parts of the platform normally. So yeah, there are cases where the underlying platform might change and that might affect a smart contract, but best practice guidelines are already taking this into account up to some point.
Okay.
There is still a risk, obviously.
Okay. I think last question because I am running out of time. So before we covered centralized exchanges, right? If the world moves to decentralized exchanges, would you trust more exchanges or wouldn't you be more happy about it? Because we've covered smart contracts and probably, and correct me if I'm wrong, right? Decentralized will use smart contracts. So have we, Paul, maybe I see you, have we gone from the fire to the pan, or?
So if the decentralized exchanges work, then we're good. But they come with like two core problems. One is speed, because we're talking about on-chain execution. So that's what we ran into the last time we tried to push it in front of centralized exchanges. And the other is liquidity.
Okay.
And on the liquidity side, the liquidity providers are that last point of failure.
Agreed.
So there's many cases where we try to inject liquidity in the decentralized system, and then we lose the money there.
Okay. So what about non-custodial exchanges, right? So there is a liquidity provider, which is the main service provider, right? Which is trustworthy and he has a lot of money to lose. But then who is actually buying and selling is decentralized. Is a non-custodial exchange a better option than a decentralized exchange from a security point of view?
Does somebody else want to take this?
One I think additional point there is you mentioned two concerns. Another big concern is who controls from a decentralized, who has the 51% attack capability. So with a lot of mining happening in places like China, I sat down and was doing a security audit for a firm, an exchange, and he showed me his wallet, the company wallet with 160 million Bitcoin in it, or some huge amount of money, hundreds of millions of dollars, and he had a very secure wallet. And I asked him what keeps him up at night, and he was worried. He's like, that's the biggest thing. We have 5 people that know the keys, so we've been friends for a very long time, but that's what we're worried about, that the miners could take over and do something. So that's another problem with centralized versus decentralized. And also, JP Morgan, all the big banks, 20% of big, people that would want to invest, institutions, there's no way in hell they're not going to invest in anything decentralized. They just can't, right? They want to know where the money is, and they want to be able to look that person in the eye and know that if something goes wrong, who's responsible. And the decentralized, it's good for maybe the gray areas of the world, but all the big guys, the Citibanks, the Goldman Sachs of the world, they're all using blockchain, but it's all centralized because then they say, yep, Goldman Sachs, you're responsible for it.
Agreed. So, yes, of course. Concluding remarks maybe, because...
I can actually address your question a little bit. So,
all right.
So like, where are the happy mediums? And I'm not sure if this is where you're going with this. But like, if we see like Binance's new DEX, their happy medium is like, okay, we'll run our own blockchain, but we'll have proxy coins. So this is all pegged to other coins, and that way we create this liquidity. There's also other examples of new protocols like Arwen, which are taking centralized exchanges, and they're allowing for decentralized players to enter. So we get the centralized order book, but you can still work from your own wallet. So you sort of remove some of those issues, but introduce a new sort of paradigm to that trading place.
Maybe next time we'll discuss what are the weak points in that structure. Yes, Jean-Michel?
I think the most major issue here is how can we decide which exchange
to trust.
Yes. we can't all be smart contract pen testers and smart contract auditors, nor I think should we have to do that kind of due diligence every time we want to invest. The average person should have a way to look at an exchange and know if they take security seriously and if they take standards seriously.
Okay.
And for that, we do have something which is coming. It'll be in alpha next week. It's called Project Hackstop.
Okay.
That's all the information I can give right now. But that's the exact problem which we're looking to tackle.
Awesome.
What would be your quickest metric for if an exchange is safe?
Again, something we can discuss next week.
We're gonna check it out next week. Thank you, guys.
Cheers.
Pleasure to have you. After you. Thanks, Stefan.
How are you? Nice to meet you. How you going? Good afternoon, everybody. It's a pleasure to be here. Another welcome summit, as always. And today's panel is going to be all about the payments. Payments is the biggest elephant with respect to the blockchain technology. In terms of the implications, what the outcomes are. When we look around, since this talk of blockchain hit the street, the biggest patent holders in this application is mostly financial services companies. Bank of America, Visa, MasterCard, Alipay, they all know what's coming. They are a lot slower to adapt in terms of what's already out there, but the payments are going to be changing. What we know of today as of payments is going to be completely different. Let me give you an example. How many of you or people here have a PayPal wallet or deal with PayPal at one point? How many of you still use it today? Literally 3 or 4 people. This is exactly the same thing what we're talking about. Payments are going to change. They're not going to be like what they are today. And the guests over here, they're really valued in terms of their expertise. They're going to give us a lot of feedback about this. I'm going to start with Jovan. Jovan is one of general managers of OKCoin. He's one of the biggest exchanges. And it's all going to be about the gaining traction in terms of the consumer marketplace and tradable security with the regulators. How is the marketplaces looking? Is everything changing, and what are your expertise in this matter?
I think it all comes down to, it depends on how we define the term digital currency. So you've mentioned these 3 cases. To me, I think of it more as digital assets, because digital assets, as per definition, can define basically the fundamentally new class of financial instruments, right? That defies your typical classification as either a security or commodity or even currency in this case. So it all comes down to the context in which we apply them and the use cases. So specifically, since the topic of this panel is payments, I think throughout the years, if we look back 2 to 3 years, we've seen a lot of players already successfully tapping this. Players like BitPay.
Absolutely.
Yeah, that have successfully allowed people to send money, receive money internationally, do cross-border payments and remittance in a safe, reliable, and oftentimes even affordable manner. And we even have cases where companies like Crypto.com are allowing people to purchase goods with their Visa credit card using cryptocurrencies. As an exchange, I think of us more as a fuel for adoption. We allow people to exchange fiat for crypto. We allow payment processors and payment institutions in the crypto space to get liquidity. And incidentally, the motto of OKCoin is making digital assets accessible to the world. So as long as we make digital assets accessible and make them and put them in the hands of the users, the more use cases we will see in the future when it comes to payments. And
Absolutely.
There's going to be inevitably a convergence of these traditional payment processors and crypto-enabled payment processors. So.
Absolutely agreed in terms of your point of views. Jovan didn't need an introduction, but our next guest, I would like him to introduce himself. David Gold. David Gold is a brilliant mind. He's done a lot of good work in terms of the coming up FIO protocol, if I'm not mistaken. Can you give us your input in what that does, how it changes the infrastructure, and what are the implementations? Because you guys are going to change the whole ecosystem.
Yeah, so let me do a quick poll first. How many people in the audience have actually sent cryptocurrency in a decentralized manner from one wallet to another wallet? Not in a centralized exchange, but actually sent Bitcoin or ETH. Just show of hands who sent it decentralized. Okay. No, not too many, about maybe 20%. How many of you who just raised your hands were completely comfortable and confident when you hit that button that things were going to go as planned? You felt completely comfortable. No hands. No hands. This has to change.
Absolutely.
Payment processing with crypto will never happen if this is the situation. So the fiat protocol is a industry consortia, 19 wallets and exchanges, Binance's Trust Wallet, Edge, Shapeshift, MyCrypto, Bread, Coinomi, and many others that are coming together working with us to build an industry standard, which is the fiat protocol. It's a usability protocol that works across every single blockchain identically, and it makes sending and receiving crypto easy, safe, no need to ever even know what a public address is, the ability to send requests for payments, which can't be done today, and do it in a 100% decentralized and secure manner. So that's where we're changing things, and it's critical to enable payment processing to be able to happen.
It's part of it. I'm eternal today.
Absolutely.
How long before you guys get this to the marketplace?
Yeah, so we're in alpha and testnet right now. Mainnet is scheduled to launch end of summer, early next year, and we'll actually be doing a pre-sale this summer of the FIO addresses, human readable addresses here this summer.
Well, looking forward to it, David. Calvin, welcome. It's been a long trip. It's been hard to get in touch with you all day. But Calvin is a very successful entrepreneur. He's got a lot of gold medals under his belt. And he's going to give us his feedback in terms of what he thinks, how the technology is going to evolve, and what we are looking forward to.
Okay, my name is Calvin Ng from Hong Kong. So basically, I manage a $200 million US venture fund in Hong Kong, and we also invested in our main project, which is called GoZip. It's a gold-backed token, which we just raised $300 million US within the last 2.5 months. But this raise is non-ICO, not IEO, and not STO at all. So we just raised this within the Hong Kong only gold exchange from 171 members. So next month, we may make an announcement that we are oversubscribed. We may hit 400 million US worth of gold raise. And by year end, we target about 1 billion. So what we are doing is that we take the old gold and digitize it, bring it back into the market so that the mass market people can invest into gold. And the second mission is to make gold really liquid, which means that you can walk into any shop and use gold to buy things or to exchange for gold or fiat. So Hong Kong Gold and Silver Exchange, basically in Asia, if you walk on the streets of Hong Kong, Singapore, China, every 10 gold shop, 7 of them is a member of the Hong Kong Gold and Silver Exchange. So you are able to walk into any gold shop and actually buy this digital gold and exchange for real gold as well, trade.
We could also use this in payments terms too.
Yes.
This is, that's
so to make it truly liquid, one of them is truly for payments. And we're starting out with all the gold shops available under the Hong Kong Exchange arm, which exceeds 30,000 shops in Southeast Asia market.
So merchant application is already there. Just a matter of putting it to the market.
So both online, offline, the whole thing has been set up.
So you guys are true believers in the blockchain technology, how it's going to evolve, where it's going to take us going forward?
Definitely, but we are more of a hybrid model because Hong Kong Gold and Silver Exchange is actually monitored by the Hong Kong Monetary Authority. And in order for us to get this, we have to become a hybrid model. We cannot afford to have, example, you have a 60-year-old, 70-year-old auntie or uncle who invested half of their life savings into gold. And then one day they come to you, I forgot my password. And you have to tell them that, I'm sorry, your gold is lost forever, you know? We can't have that. So we have to be a hybrid model whereby although all our data is recorded on the blockchain, we have a main centralized database.
So basically every token will be exchangeable to gold. If I go to a gold shop with my token, I'll be able to exchange and get physical gold out.
Yes.
Perfect idea. My next guest is Ivan. I mean, Ivan is very good in terms of what he does. He's the co-founder of STO Box. There's a lot of news, a lot of stuff going on, STOs, IEOs, ICOs. I'm losing the vocabulary. Give us a bit of a breakdown on what you guys are doing, how the market is going forward. I mean, there's a lot of talk about ICOs, but not much stuff coming onto the marketplace. How do you guys see the whole thing?
Thank you for the introduction. So, yeah, like, my name is Ivan. So the last year I'm focusing on the tokenization of real assets. So we built the platform for tokenization on our own private blockchain. So, like, I'm focused on compliance to make all this transaction with the security tokens globally compliant, because everybody talking just about compliance and the global compliance, but today, let's be honest, it's not working like that. And from the second part, it's like a technical part of tokenization. For example, you just mentioned gold. Actually, it's no matter what you would like to tokenize, so you need the whole process, the whole infrastructure. So we focused on this technical infrastructure, and we decided to make it on a private blockchain, not on a public, because we believe that all, we made a lot of consultation with different enterprises, and what we heard from them that they would like to use the private blockchain because they would like to control the whole ecosystem. And blockchain for them is just a database. So, they can hold maybe 4 nodes, or maybe give the 5th node to their lawyers to make the real-time transactions. So what I'm focused, it's so we're building the platform for tokenization also with a wallet. So a wallet can be actually, we call it financial internet gateway, because we believe that in the future, people would manage their assets and the digital assets in the digital way. So, the wallet is one of the key point of infrastructure. So that's what we do. Actually, I'm not involved in ICO and IEO, so we decided to focus on the STO market because it's fully legal compliant, and I believe that in the future everything would be compliant. And because you take these rules or you don't take these rules. So, so we decided to take these rules.
Well, looking forward to the product coming out of the
payments, payments is one of the key features that we focus, because everything is, what we've done is because to make the payments much more
adaptable.
Better, yeah.
Mm-hmm. Jovan, I'm going to come back to you with a question.
Okay.
Since you guys are one of the exchanges, in terms of stablecoin adoption, how are people comfortable in terms of using stablecoins as payment instruments? The volume of most of the stablecoins with respect to crypto volatility, they are usually exchanged to Bitcoin to be able to hedge according to the volatility of the coins. Do you think they're going to have mainstream adoption going forward?
That's a good question. From what I've witnessed, stablecoins are a very convenient way for people to park their assets when they're trading on exchanges. I think going forward, it is too early to say. We've witnessed these issues that Bitfinex had with Tether. There's a lot of risk involved. It's questionable whether these stablecoins are in fact backed by actual assets, right? Really stable, as you said. But if we see a emergence of these trends where people are trusting the reserves, I think this is in fact a digitized fiat money, so it definitely has a shot at becoming
mainstream adoption.
Becoming
right?
mainstream, yeah.
That's really good point, because in terms of, when we look at the stable coins, they are very useful. They work better than money, and they could even do a lot better things than money. So take it to the main street instead of credit cards or mobile wallets. It's my mic.
Yeah.
Well,
I thought it was me, but it's probably.
David, I'm going to come back to you. Like I said, I'm one of the people that are looking forward to when the FIO protocol is going to come online, and I would like to have a chat with you after the discussion to get more feedback. In terms of the inter-wallet operability, is this something that could be achieved today and then scaled down to, the rest of the blockchains?
Oh, it definitely can be achieved today. The hard part, there certainly are hard parts in the technology, but the harder part is bringing the industry together. For what we're doing to work and to really create usability, we have to do for blockchain what HTTP did for the internet. And HTTP is an industry standard.
Exactly.
You wouldn't make a web browser that doesn't support it. That's the vision for the FIO protocol.
What does it take to get the support from other providers? Let's say in terms of Jovan is here. What is your point of view in terms of FIO? Would you guys be supporting something like this going forward? Would you like to test it around first?
Yeah, so as far as, I'll answer first, and then I'd love to hear them. But the reason we've been able to get so much support so quickly, and it's growing so rapidly, is that the FIO protocol is built from the beginning as an industry consortia. They're able to guide this protocol. The governance in the blockchain will be heavily influenced by wallets and exchanges. We expect a lot of the block producing nodes to be run by wallets and exchanges because of how the economics are set up. That also means that long term they will benefit economically. So they benefit with better usability for the users and economically, and it's a protocol they can guide. So those have been the key things we've done.
It's a win-win model, basically.
Right.
As an exchange, we facilitate the needs of a market.
So whatever, whatever the market needs.
Exactly. So we are there to facilitate the needs of users. If this proves to be an efficient way of people to transact, then we're there to facilitate it, as we do with stablecoins today.
You just got to support. Calvin, in terms of your point of view as an investor, what sort of project do you guys look up in terms of payment space? I mean, do you have any project that's coming on your lap in terms of they're asking for money for?
Well, we look at many projects every month. I think at least 100 to 200 projects as a whole. And payment, fintech is one of the areas that we really look at. That is also the reason why we launched, we invest heavily into GoZip, and we really help them to launch. Is we believe that, like what he said, is the trust factor, the branding factor is very important. If today HSBC were to launch a stablecoin, everyone would believe in HSBC.
Exactly.
Okay? No, nobody wouldn't say that, or Citibank. So I think the biggest challenge that is coming from in the payment space has every time a payment company comes to us for investment, I will ask them this: so how do you fight against Facebook coin that is coming up? See, that would be your biggest challenge. We don't even need to talk about Citibank or HSBC and so on. Let's just talk about Facebook. How are you going to tackle this?
I mean, I'm happy with the news because the fact that this just shows you how blockchain technology is going to go to Main Street. It's either Facebook or whoever's out there. This is basically credibility saying that this is viable, this is going to go to...
Exactly. We as investors or people in the blockchain space actually should not be afraid of Facebook.
Yes.
Today we have 50 over million crypto users, but when Facebook come in, we are going to look at 200 million, 300 million
users.
adopters.
Yes.
That's going to adopt. Suddenly people will start having wallets, and without them knowing, they are actually using a blockchain wallet.
That's
and this is very important.
Yeah. Thank you, Calvin. In terms of, I mean, how STO box the model, how would you guys be processing payments in and out of the system? I mean, would you guys be using any blockchain-based solutions or just regular fiat exchanges? How would this work?
I would just add my point about the Facebook and also like about the Telegram. So actually they're doing a great job because we don't need to spend so much money for education because they're doing actually this job because once Facebook users and Telegram users will use the cryptocurrency and their built-in wallets. So actually it's a huge work for adoption. Let's be honest, because we don't have such huge budgets to to bring this adoption to the masses.
That's why we invested 10 million in Telegram.
Yeah.
Calvin, I'm going to send you our project next. You haven't seen it yet.
Okay.
It's been a great honor to have you all here. I mean, I'm sure we will have a lot more to chat about this because this is one of the biggest elephants in the room. I'm sure a lot of you agree on this. Really valued people, thank you for coming up and thank you for giving your feedback.
Thanks for having me.
Thank you for listening to us.
Thank you.
Or
Hi. Hi, everyone. I think now we're going to have interesting panel discussion. The topic is traditional currencies versus cryptocurrencies. The guests of the panel discussion are José Macedo, Andrea Castiglione, Matthias von Hauff, and Arnaud Salomon. Hi, guys. My name is Dushan Spalevich. I am the founder of iBlock Capital. It's a global fundraising and investment network. I also run a YouTube channel, iBlock TV, and I will be moderating this panel. Guys, maybe first in the beginning, just say some words about yourself, please.
Hi, I'm José.
Yeah, the microphone.
Sorry. Hi, guys. I'm José Macedo from Amazix. We're a full-stack advisory firm. We have about 80 employees across 4 divisions, and we help with every project, every part of the token sale process. So we've helped over 120 projects raise over 1.3 billion at this point.
Wow, congrats.
Cheers.
1.3 billion, yeah?
Hi, I'm Andrea Castiglione. I've been involved in the blockchain space for quite some time, and I'm always been interested in how do we bridge the gap between fiat and crypto, and how do we build the next, how do we build the technology that is going to allow the next 100 million to 500 million people to get into crypto.
Hi guys, my name is Matthias von Hauff. I had an idea to open up a bank when I was 20 years old, and it took me about 15 years to open up my first bank, which was sold a few years later very successfully. And a second time round, I said to myself, hey, this space needs another bank, and that's WEG Bank, which I run today. It's relatively young still. We're now in our 4th year of operation, and we're, to my knowledge, the only bank that is actually 100% committed to going fully crypto as a second line of business to the existing business.
Hi, I'm Arnaud Salomon, based in Geneva. We're also building a bank, actually, fully licensed, which is based on 3 fundamental pillars: full reserve, marketplace, and tokenized. It's not a crypto bank. It's a pure bank based on blockchain, where we aim at bringing the entire balance sheet on the blockchain, tokenized in real time.
Okay, so traditional currencies versus cryptocurrencies. But first, I would like that we discuss about one important event that it's taking place exactly in 1 year from now, on 23rd of May 2020, which is halving. And some stats about the Bitcoin. So the total supply of Bitcoin is 21 million. Up to date, there was 17.7 million Bitcoin generated. Today, daily, there are 1,800 Bitcoins generated, which means approximately 3.8% of inflation. Starting from the next year, the inflation will drop to less than 2%, which makes to approximately 1.8%, which makes Bitcoin less inflationary than the traditional, let's say, developed currencies from, like, let's say, a dollar. What this will mean for the whole ecosystem? Guys, just go on. Andrea.
Well, every person that talks about halving in terms of, the Bitcoin price is going to go here or the Bitcoin price is going to go there, I think we don't have a crystal ball to understand what the effect is going to be in the long term. But just from an economic perspective, something that it becomes just twice as scarce, it becomes more valuable. So the economic reward per block is going to go down, and so that means that people are going to spend more money probably to buy the
Sure.
Bitcoin.
Instead of 1,800 daily Bitcoins generated, it's going to be only 900 generated from the next year. Yeah.
Yes. Perfect.
Okay, please, Arnaud.
Yeah, I just would like to go from the beginning. Like the first question is, what is money? Yeah, and when you ask this question to people in general, they tend to answer it's a medium of exchange, which is only half of the answer. It's also a store of value, right? And that's a way for you to defer payments, to make bigger payments in the future. Therefore, if you look at it, inflation today is something that is accepted by everyone as a natural fact. Like gravity, I drop something, it falls on the floor. Every year, prices increase. And it's not actually a natural fact, it's a human fact, right? And in this regard, I believe that it's very important to actually understand why we have central bankers as well that can decide for the monetary supply, that can decide for all these things. And what Bitcoin is bringing here is somehow a projection, something that you can really truly forward looking at, instead of just like trusting some like guy that is not even elected to actually deal with such an important thing as a store of value.
Yeah, I maybe like to add that if we're looking at that figure of 2% inflation on Bitcoin, roughly then, we need to look at historically, we're now living in an environment of extremely low inflation, which we haven't seen for a long time. Think back to the early 90s where Deutschmark, one of the most stable currencies there were, was at an inflation rate of more than 6%. So I don't think really that, if we can call it inflation, a Bitcoin inflation has anything to do with the value of Bitcoin, which is as it is being perceived in the market. I think any digital currency at this stage where we're at in the life cycle of digital currencies is driven by usability, applicability, and not so much the inflation factor.
Yeah, I think it's a really good point Arnaud made as well about money, and money being a store of value, because what we have today is actually fiat money is not a good store of value, right? It's literally loses value every year.
2%, yeah.
Yeah. But 2% in developed countries, but we have about 500 million people living around the world in countries with over 10% inflation, right? Where you're literally getting taxed 10% every year on your money. So it's a really important thing, right? Because what we have as well with this quantitative easing is, central banks buying assets. So most poor people hold money rather than assets. Most rich people hold assets. Assets go up in value. Money loses value every year, which is why the wealth inequality is the worst it's been since the 50s. Right? So I think the Bitcoin halving is important because it reminds people of what money should be, what sound money should look like. And in terms of price, again, we don't have a crystal ball. Technically, it should be like inflation expectations. It should be priced in right now, but it tends to not be. And I think it's because it sort of reminds people of this musical chairs kind of game that we're playing, right? Where people remember there's only 21 million of these, right? And Travis Kling always says Bitcoin stops the music. And suddenly all these institutional investors, these banks, have to sit down and choose whether they want to hold one of these 21 million Bitcoins or whether they want to wait until it's more expensive. So,
Traditional currencies versus cryptocurrencies. I would like to hear from you the opinion. Do we have here the battle between the cryptocurrencies and fiat currencies, or they should live in kind of symbiosis in the future? Keeping for the fiat currencies kind of dominance in certain financial markets, and cryptocurrencies take over some other financial markets that are better at. What do you think? We have the fight here, the battle, or it's like, as we call it today, co-petition, collaboration and cooperation? What do you think? We have the battle here, and who's battling who?
Well, I think we have a bit of both at the end of the day, because nothing in this world is black and white, is it? So I think digital currencies and traditional currencies, fiat currencies, aren't really comparable in the same way that you can say it's either this or that, given the fact that one is completely uncontrolled by governments, at least to a large extent, and the other is entirely in the control of governments, and governments live off one thing, and that is control, and they don't like to let go. And
but don't you think that the governments will take slowly control over the cryptocurrencies?
Yes, that's one of the things that I could theoretically see happening. I mean, any regulator will try to regulate what you can do and what you can't do with crypto in a regulated market. So at the same time, I think there is such an impact and such an impetus in the digital currency movement already that governments around the world can't really entirely stop it either. So I think there will be a little bit of both.
Yeah, well, as well, I mean, if you look at it, like in Switzerland right now, you have like the Swiss Stock Exchange, which has like, right now is trying to tokenize the Swiss franc, to bring to the market a crypto franc. So there are like initiatives, going on as well to bridge the kind of the two worlds. But at the same time, as you said, it's the state is all about the control. So of course, when you tokenize the Swiss franc, you need to have a compliance layer on top. It's not something that is going to be like freely transferable like the Bitcoin is, because obviously the state is afraid of money laundering. They want to control things, etc. So at the end of the day, there will be convergence in the way the technology works on the back, but it's not going to be ever comparable to Bitcoin. Bitcoin is about freedom for all. It's about like, having the possibility for anyone, anywhere, just to download the wallet and start using it. Whereas the fiat, it will always be some kind of, you will have third parties being the gateways, being the compliance guys, being the compliance oracles, etc., etc. But is it bad, is it good? I don't know. But at the end of the day, if all countries go and start to tokenize their own currencies, if we tokenize the euro and the ECB tokenize the euro, etc., then we'll have more competition, and it will be easier for people to switch from one, and therefore central banks will be in competition between each other to have sound money.
Well, also some points about trust and also digital money, because if you think about or asset-backed dollars, like if you think about it, only $4 trillion are actually available when 70 trillions are in circulation. So we already have digital money and store of value. It's the fact of I accept $1 in exchange of some good or service that it's equivalent to that dollars that I spent. So it's the value that we give to money. And regarding the fact that Arnaud was saying, like trust is one very, very important piece about the Bitcoin. Bitcoin, I don't believe Bitcoin is a currency. I believe Bitcoin is an application that it's built on top a decentralized network, that it's a trust network, that it's the blockchain, the Bitcoin blockchain was built to decentralize trust and to take away a layer of I have to trust a third party in order for me to keep a ledger of who has money, who doesn't have money. And the fact that it's ownerless and it doesn't have a control layer or it doesn't have a government, it implies that I can trust the cryptography and the mathematics behind it, and I can build applications on top of it, currency being one.
Yeah, I mean, state-backed currencies are interesting, but as Andrea said, money is already digital. Most of us interact with money through credit cards, with pixels on your bank account. Only 10% of money is actually physical, hard money out there. Most of it is credit, and it's digital in nature. So a state-backed currency is interesting. It's marginally better technology than what we have right now. It makes a lot of sense. But I think what's interesting about cryptocurrency is that this money that we use right now literally lives in an SQL database at a bank, And what cryptocurrency does is it takes that SQL database at a bank and puts it in thousands of computers around the world where it can't be altered. People can interact with it trustlessly and permissionlessly, right? So I think that's the real innovation of cryptocurrencies in terms of competing with other money. I don't think they're going to be competing on the medium of exchange part of money anytime soon. But I do think as a store of value, we're going to see competition very soon. And if you believe in sort of the Nick Szabo historical theory of money, then that's how money starts off, right? It starts off as somewhere that people store value, similar to gold. So I think its use case is probably something like that. And as we get scalability in layer 2 solutions, you'll be able to have sort of Bitcoin-backed banks, where you have Bitcoin in reserve and you can issue a stable coin or some kind of currency on a layer 2, but it's still tracking back to the Bitcoin main chain and having all the benefits of decentralization and stuff like that.
The traditional guys from the banks, they have the objection that the Bitcoin has no intrinsic value. How can you compare this? What is the intrinsic value of US dollar or the gold? I know that you wrote a nice article about the intrinsic value of Bitcoin. How can you comment on that?
Well, intrinsic value is kind of a tough word because people define it in many different ways. If you talk to someone like, if you talk to a philosopher, it means something very different than if you talk to Warren Buffett, right? Warren Buffett would refer to it as something that generates cash flows, that generates something of value over time. And some cryptocurrencies do that. I sort of divide cryptocurrencies into crypto capital and crypto commodities. Crypto capital have intrinsic value in the sense that Warren Buffett and most people refer to it as, and that they generate cash flows. And these are both security tokens on one side and work tokens on the other side, right? Something like Augur or something like that. But then you also have these crypto commodities, which similarly to money, similarly to gold, similarly to oil, don't generate cash flows, right? And they have to be valued differently. So you have cryptocurrencies, which fulfill some role of currency. And then you have also the collectibles, right? Non-fungible tokens, which again are another huge asset class in the world, which includes art, it includes a bunch of stuff, which also have to be valued using supply and demand. But for currencies in terms of intrinsic value, I think what you're referring to now is the JP Morgan post they made recently about Bitcoin's intrinsic value being $5,000. And that just shows a complete misunderstanding of how Bitcoin works, because the formula that they're using is basically a cost of production formula. And one of the inputs there is hash power, which is actually a completely recursive and circular with the price of Bitcoin. So they're basically using two variables that are correlated and then saying that it explains one another. Of course it does. If the price was 5,000, we'd have a different one. So it shows a complete sort of misunderstanding of cryptocurrency. I think that the way to value it, at least the best attempts we've seen, is people who are trying to use the equation of exchange, right? That was traditionally applied to currencies, the MV equals PQ, and trying to model various aspects like velocity and stuff like that to get to some kind of value. But yeah, it's difficult. It's, in financial markets, they were born in the 1600s, and it took until 1930 for us to get the discounted cash flow model, which is now ubiquitous. This has existed for 10 years. It's normal that we don't have a way to value it, but that doesn't mean it doesn't have value.
On my side, what I would say is the value of Bitcoin. When we talk about intrinsic value of Bitcoin, I would think about all the smart people that are building on top of this technology, all the people that have, that are
including Microsoft recently as well, digital identity.
Well, absolutely, digital identity, but for sure, it's people that are building on top of this decentralized network of trust, and they're building on top of this technology, and all the people that are willing to exchange a Bitcoin or a portion of a Bitcoin for goods and services, and this is growing over time. So it's just been 10 years. It's just been 10 years, and the number is growing exponentially. And I think this is the intrinsic value of the currency. One day we'll stop just saying one Bitcoin is worth 5,000, 7,000 euro, but we will say 1 euro is worth 0.000 Bitcoin. I mean, this is the reality. Like, one Bitcoin will always be one Bitcoin. And I'm a bit of a maximalist in that sense, but this is the reality of it. Like, more and more people are building on top of this. So that's the value that I see.
Well, thank you very much for pointing out that everybody understands something very different with the word intrinsic value. I agree with that totally. I think the one thing that all currencies, be they digital or be they fiat currencies, have in common is, to an extent and to a large extent in my book, their value is determined by the belief of the public that it will still be there tomorrow and hold its value tomorrow. And that, to me, is the intrinsic value of any currency. I mean, if I gave out the Matthias token, if you all believe in it, well, it's going to soar, isn't it? It's going to have an intrinsic value. But the same holds true for Bitcoin. And I believe, seeing from where it came, from being pittance worth to where it is now, there's a huge amount of intrinsic value in that, because the whole community can see the future, and it's a bright future at that.
Yeah, I agree. It's all about the trust, and it's all about what people think about what it's worth. So if I show you this, what do you think this is worth? So most people would say this is worth 5 euro, right? Because it's written on this paper. But if you look at the intrinsic value, it's not really worth more than any toilet paper. It's just paper, right? But because we all agree on the value it has and that you would accept in order to buy something in return, well, we believe it has this value. Now again, so Bitcoin is all about the same. So if we're all in this room, it's because we believe Bitcoin has value, and therefore, the price is going to be determined by the market, and that's all about it.
Mm-hmm. Cool. Guys, I'd like to ask you, how do you see the world in 5 years from now? I mean, for the average user. I heard from you, Matthias, that you believe that credit cards are not going to be here anymore. What about the payment terminals? How the guy coming into the Starbucks or the retail shop will pay? What will be the method? Gonna use the smartphone? It's going to be fiat, new fiat cryptocurrency, or stablecoin, or he's going to be paying with Bitcoin. How it's going to look like in 5 years from now?
I certainly wouldn't want to be quoted in the paper saying Matthias said that in 5 years there won't be credit cards. So I didn't say that. I said further down the road, just like LPs were replaced by CDs and CDs were largely replaced by MP3s and MP3s were replaced. So yeah, I think the world will look differently. Same again, we don't have a crystal ball here, but definitely I think adoption is coming. We don't know at what rate, but it is coming at an increasing speed. And let's not forget, 5 years down the road, my 9-year-old boy will be 14 years, and he will be out there making payments. At the moment, he's got a little bit of pocket money in coins and in bills, but he will be out there making payments with a smartphone. I don't think my 9-year-old is ever going to use a credit card. That's my expectation. And I think on the panel before, they were talking about the idea that about the fact that Facebook are discussing a Facebook coin. Yeah, there will be instances which will introduce a huge step forward into the mass adoption, and we very, very much, as WEG Bank, hope to be part of that.
I just would like to say something. So in the first place, why did we invent credit cards? Credit cards were invented 40 years ago, 50 years ago, for the simple reason that we didn't have any instant settlement layer. So that's why it's called credit card and not debit card. We invented that exactly for this reason, because when you make a payment, because you have no way to actually settle it instantly, what we had in the past, Well, we invented this plastic card. Now it became something more like a kind of social status thing. People are kind of, showing off. I have the black card, I have the silver card, I have this, I have that. So I'm not sure the plastic thing will disappear anytime soon, simply because it's becoming a very social thing. Now, the payment route on the back is changing drastically. You see now in Europe, we have instant SEPA. So why are we still using the Visa, MasterCard type of settlement layer where they take huge fees and they charge enormous fees to the merchants? The chargeback issues for the merchant is massive. Now with instant SEPA, you can have like the kind of, cards linked to, and you could choose like actually which kind of payment route you want to have there. Again, the credit card was really invented for the idea of credit. Now we are going, I think, more and more to have like instant settlement cards, and the credit will be, of course, provided by the bank itself and not by this Visa MasterCard layer.
Yeah, I think that's a really good point. And credit cards are basically a layer 2 on top of money. It's very similar to the sort of Lightning Network on top of Bitcoin. I mean, and what you see with stablecoins now is if we think about money going digital as we're thinking, it's really important that we also think about the decentralized architecture stablecoins, because if we're going to use something like Gemini coin or something like that, it's not too different from what we have right now. And if we have a world where money is fully digital and it sits on a centralized database, that is a full surveillance world, where a government or a hacker can have access to all your financial purchases, your financial history, all of that. So I think it's important to sort of, when we talk about stablecoins, to remember that the decentralization aspect is very important. If you're just putting coins in a bank and issuing a stablecoin, that's not too different from what we have right now. Again, it's marginally better technology. And then in terms of where we'll be in 5 years, I think one thing that's important to remember is that we're currently undergoing the biggest financial experiment in history, and it's not Bitcoin, by the way. It's globally coordinated quantitative easing, and 245 trillion in global debt, which is, nearly 300% of global GDP, And so when we start talking about these numbers and the fact that, currencies which are backed by the state's GDP and the state is indebted to 300% of their GDP, then we start seeing sort of the potential for Bitcoin to emerge, firstly as a hedge to that, and then secondly, right now Bitcoin's a risk-on asset in most of the world. It's something that interest rates go down, Bitcoin goes up. It's a risk-on asset, but it's not a risk-on asset in Venezuela or Zimbabwe, right? There, the local currency is the risk-on asset. And I think what we can see with this debt crisis that's emerging is end up in a world where more and more local currencies become risk-on assets in comparison to Bitcoin, right? Which has programmatically set inflation, is deflationary over time, it's much more easily transferable, etc. So I think it's important to sort of keep that in mind as well.
Yeah. So the previous panel discussion, they were discussing about the Facebook and the potential number of the new crypto users just thanks to the Facebook can be 200 million, 300 million. So obviously we are growing the number of crypto users. But so tomorrow, let's say that we have coins here in the wallet. But if I cannot go to the shop and buy and purchase with the cryptocurrency or buy the taxi drive or whatever, then it's useless. What do you think in 5 years from now? It's going to be like mass adoption from both sides, from the merchant side, from the consumer side. So basically also the unbanked people can open the wallet, store the cryptocurrencies there and live freely, paying all different kind of services with cryptocurrency. So this is the ultimate goal, right? What do you think?
Well, I think there is some points to be discussed in that sense, because first of all, talking about Facebook, I think conversational interfaces are very, very important in terms of mass adoptions, because my grandma doesn't know how to read a chart, but she definitely knows how to send a text. So if I can send money as easily as a text, that is a big gap, like a big step forward. Who's owning the infrastructure for me to send that text, then it's another conversation. So if it's a centralized infrastructure like Facebook or WeChat or KakaoTalk or any of these conversational messengers that are working into this, that's a point of conversation that we can have. 5 years from now, I don't want to be held accountable either for saying things like this, but I do believe that until the moment in which the merchants are hearing, cryptocurrency are a bubble, or cryptocurrencies, or like banks will not even allow you to have a cryptocurrency account. like here in Malta, it's very different. It's very difficult to be banked if you want to trade cryptocurrencies. Like it's incredibly difficult, almost close to impossible. So for the merchant, it's not easy to go and say, hey, yes, pay me in Bitcoin. But we have to look at the reality that Bitcoin is the best performing asset, like by far. Like if you look at this year in numbers, like Bitcoin has outperformed everything else. So it is volatile, but it is also a better and more stable solution than many other currencies around. And if you see it as a store of value, I think 5 years from now, people are going to start understanding the intrinsic value, talking about intrinsic value of the network and the trustless network that Bitcoin has built and all this brain power that is going into the infrastructure. So I think that's where we're going. And I think 5 years from now, it will be widely more accepted that people will just, accept, even if I'm a baker, I will be able to give you bread instead of Bitcoin. So that's something.
Guys, what do you think about without the crystal ball 5 years from now? Can we buy basically everything with the cryptocurrencies?
Well, in lack of a crystal ball, again, I don't know. But what I do know is there is an enormous, huge amount of brain power and commitment going into that. And it just by the fact that so many people, intelligent, well-educated people who have so much power and so much drive, and especially young people, are fully committing themselves to that sector, I believe there can't be any other way than that. I mean, we have a partnership with a team of young people, the team NIMIC. We're working with them on trying to, or not even trying, we're actually proving that it's working, on building a bridge which is absolutely seamless between fiat and crypto. And yeah, once these things come onto the market, nothing's going to stop it.
I wouldn't commit on the 5 years from now, but I think it needs a trigger. It needs like an event to trigger that. If you look at it, the 2008 crisis, most people believe it was solved. In reality, it was solved by actually creating more debt, lowering down the interest rate in order to repay the previous debt. So right now, we are creating an even bigger bubble than we used to have. Now, when the next 2008 crisis will come and the shit will hit the fan.
So this is a crystal ball. We have this crystal ball.
I can't commit
okay,
on
it will
years,
come.
But
okay.
When it will happen, and it will, that will be the tipping point where Bitcoin will be seen as the average people as shit. I missed that, and actually, this is the answer to pretty much all the problems we're facing now. Up until then, people will continue. I mean, at least in the first world country. They won't face any problematic yet, so they don't have the willingness to actually move to anything, right? So if you go to France, for example, try to pay in dollar, it's impossible, right? So again,
exactly, yeah,
yeah, and I think great point again, and historically, the average age of a fiat currency is 27 years, right? It's very hard as a state to resist the temptation to print currency because it's basically a tax that you don't have to get through Congress or whoever your parliament is, right? So, even the US dollar, the almighty US dollar, in its fiat format is only, something like 40 years old, right? So while it sounds ridiculous, when we talk about Bitcoin becoming a store of value and stuff, I think when you look at its road so far, all the elements are there, right? It's proving itself to be an uncorrelated asset class. Even more recently, where stock market has tanked due to trade war tensions, Bitcoin has gone up, right? This has happened multiple times. And I think that will only accelerate, and it has to win sort of that use case first before becoming a medium of exchange, but I think we'll get there.
Guys, our time is up. Thanks a lot. No crystal ball. Thanks.
Something like that. Don't say that. Don't say that. Don't say
that. Hi. Hi. Yeah, you loved it. Yeah. I block TV. Yeah, yeah. But it's like more for fun. Yeah, yeah. Yeah, yeah. It's important that you enjoyed it. Yeah. Cool. Welcome. Okay. You're Italian? Nice. I'm from Slovenia. Sì. Parlo anche italiano un po', non così bene, però. Lui deve che...
All right. Hello, everybody. Are we ready for the next one, which is FX token? My speech, 10 minutes, very fast, bridge to fiat. Let me first introduce myself. My name is Oliver Prock. I'm a hedge fund manager since 16 years. Basically, core strategy, quantitative, managed futures. Not sure if you know that strategy. But we also do crypto now. So basically, we are, I would say, one of the traditional guys that basically entered the space. And because we are trading crypto risk on, risk off, we need a stable asset, a risk-free asset, right? And because we are unhappy with Tether, it seems like I thought the space is unhappy too, but every time there's a problem with Tether, it gets recapitalized, so maybe the space is happy with Tether. We're doing our own stable coin, which is not just a stable coin, it's also a fiat gateway, because obviously 2019 seemed to be the year of the stable coins. So we agree, and I think this is one of the core issues for adoption that needs to be solved. All right? Our stablecoin is different, and I'm going to it in a second, but let me first read these two sentences. Finance is not merely about making money, it's about achieving our deep goals and protecting the fruits of our labor. It's about stewardship, and therefore about achieving the good society, Robert Schiller. The other one, earnings don't move the overall market, it's the Federal Reserve Board. Focus on the central banks and focus on the movement of liquidity. It's liquidity that moves the markets. I couldn't agree more to that, actually, because this is really some kind of describing what decentralization is, what the movement is all about, that liquidity matters, obviously, that the banking system is some kind of broken. I come from the banking system. I have been in the banking system all my career, quite a long time, but I must admit it's the most inefficient industry on earth, right? It's expensive, it sucks, it's slow, it's prohibitive. You couldn't agree more, I guess, in that room, right? We're all maximalists here, right? You have seen that chart before, but for me it's really mind-boggling to bring it again and again and again and again. This is what a dollar is worth as of today from 1913, right? So $1 now is worth 5 cents in regards to purchasing power, right? You still have $1 in your pocket, but purchasing power is only 5 cents. But what more important for me is here two events that happened 1944 and 1971. 1944, Bretton Woods established the US dollar as the world reserve currency. That's actually quite interesting because it looks like politics and the tension with China and Bitcoin, everything is trying to get rid of that world reserve currency dollars, right? So there's something going on a macro picture, which is for me quite interesting to see how that one will play out. 71, Bretton Woods again, decoupling from the gold standard, right? So dollar was not backed by gold anymore. These are quite two important dates you should remember, because it seems like we are again in this cycle from a macro picture. So something about the macro picture, and this is my heart as a fund manager, right? You see, we already had one time zero interest rates, and that was Great Depression, 1930 to 34. If you look to the blue line, which is T-bills, right, short-term interest rates in the United States, you see there was zero. So we already have been there where we are right now again. Not in the United States, because they were not that stupid as Europe is or Switzerland is. We have negative interest rates, short-term interest rates. But over there, right now in the US, we have 2% something, right? So not there anymore at zero, but we have been there in history. And what I want to deliver with that chart is that in 51, so Great Depression ended 1937, 14 years later, in 51, interest rates were at 1.5%. So basically a long time, no interest rates. If you follow that curve, and you remember 71 decoupling of gold standard, short-term interest rates, T-bills, were at 3.5%. That's, I don't know, do the math for yourself. Basically 34 years later, still no interest rates. So interest rates are gone, right? We have heard about, the panel was amazing actually, the one before. We've heard about this huge inflation of debt that we have seen, right? And there is no escape from that one. So coming back to the macro picture, and there's something going on basically, right? Because in that period, till 51, we had one event. You all know that what happened in 55, right, and before. And Bretton Woods in 71. So basically, the reset button was pressed, basically, and it will be pressed again. And this is actually why Bitcoin really has a future, from me coming from the traditional space, believing in it. So I love Bitcoin. Who in the room loves Bitcoin? You see? The room loves Bitcoin. Perfect. So there is something going on from a macro picture, and Bitcoin could be really one instrument that solves the problem that we are currently facing in the financial system. Because there is no way you can get rid of the debt. It can only expire, and that takes forever, right? At least 20 more years, and so on and so forth. Something is happening. Oh, okay. All right, it got multiple clicks. So what we are doing is, basically, as I told you, we need a stable coin for our strategy, and we're unhappy with, basically, I mean, it's decentralization. Who in the room believes that we can decentralize everything? Brad, I'm sorry, you are by yourself nearly. I don't believe that. The reason for that is, once you end up decentralize everything, you end up at a custody problem, right, at the end of the day. It works for self-custody, but you cannot do everything self-custody, right? You cannot self-custody a real estate building, right? A building as such. You can't do that. It's not possible, right? So you need a custodian. We cannot get rid of the custodian problem, some kind of. So the current, basically the current stablecoins we see is basically backed by fiat, right? But backing by fiat has a problem, because if you put the money into a bank, let's say 20% of your 100 million you issued, if the bank goes bankrupt, the money's gone. There is no insurance for that money. The money's gone. Right? So backing by fiat is actually a problem. So just to talk about the Internet of Value of Money, obviously you see that we're just at the beginning. This is what the chart should tell you. The opportunity is huge. Some important numbers: USD in circulation, 1.5 trillion. Bitcoin, not sure what the current number is, but probably around or a little bit more than that, 67 billion. So you see where money, or the future of money, is actually going. And I think the future of money is digital, for sure. So what we do basically is, any currency, dollar, euro, sterling, Swiss franc, Japanese yen, but we back it by government bonds. That might be intuitive for the Bitcoin maximalists here in the room, but there's no better asset than government bonds. it's AAA, right? Isn't it? So there's no better asset than government bonds. For me, it's intuitive as an asset manager to back it with government bonds. For a decentralization maximalist, it might not be. But at the end of the day, nothing is standing anymore. Governments will stand. Especially for the dollar, we use US treasuries. For euro, we use government bonds, like German bond. For yen, we use Japanese government bond. For Swiss franc, Swiss government. They will stand. There's no way they are going away. We can be maximalist as long as we want. They will stand. So in regards to counterbody risk, backing it by government instead of fiat is a way better solution because you're not depending on an uninsured deposit with a bank. The opportunity is huge. Global payments, there's a revolution going on in global payments. Remittance, 600 billion, $1 billion for global payment, peer-to-peer transfers, and so on. So these are the solutions out there, even though I must say the slide is a little bit outdated because Basis gave up, right? They gave the money back. I'm sure you have read the press release. They gave back because they said we can't do it from the regulatory perspective. We can't do it. It will be a security. We are actually licensed in 16 years. We have a structure in Luxembourg. We say we can do it. I don't see a problem to do it. We come from the regulated space. Tether, backed by fiat. I think I did tell about my concerns about backing by fiat. I don't like actually this backed by gold, right? That's the custody problem again. They're also out there. This is the custody problem we again had, like I described before. And gold is a volatile asset, right? If you have gold, it's still, I don't know, 10% volatility, so it's still moving up strongly, etc. The MakerDAO and these decentralized, fully decentralized stablecoins, they are quite interesting experiments. We will see how that one plays out. I'm in the camp, we cannot decentralize everything. We need more time to do that. We are on the way, but let's say 5 to 10 years, who knows what's going to happen. So I see the problem mainly because the space is some kind of merit with Tether, but I think that's a risk. Because if Tether goes down, the exchanges say, well, we didn't lose the money, the client did lose the money, but that's not true, because the regulator will go after the exchange, right? So the exchange will go under as well. So I think that problem needs to be fixed, actually. But again, it's like, I feel a little bit like, it's a tough sell because Tether is really strong in the market. But to do loans, salaries, goods sold, anything, you need a stable currency that is really reliable, right? All these press releases about Tether and all these problems, and the Attorney General moves on, it's a problem. So again here, what I'm trying to tell you is that $1 government bond is a better backing, a better hedge for the value of the stablecoin than anything else. And I hope you can agree. This is what we have done so far. Basically, we're fully set up. We did finish that project in November, but we did not yet fund it. So it's not live actually, but it's fully done. Because we come from another perspective. We come from a regulator being regulated already 16 years ago to perspective, okay, where is our place in crypto? And I actually I'm in crypto now for 2.5, 3 years or so. And it was quite a tough journey, to be honest, because I couldn't figure out where our place is, right? As a regulated asset manager, I tried to figure out where's our place. And it some kind of felt for me normal, but I needed time to understand the space. And it was not simple, to be honest. So here we go. That's the ticker. Stablecoin contract, the smart contract is released. It's not, again, this is the most part, it's not a tech problem, it's a legal problem, right? And the legal side is easy for us to solve. The tech problem, we did, by the way, in-house. That's quite interesting because most of the people wouldn't expect, we're a quant shop, so we have coders in-house, so we did actually solve the tech side also in-house, which was a learning curve because all the solutions in blockchain are some kind of difficult for a standard coder to apply or to use. So here we are on the timeline. Funding, this one before, we have not done it yet, so we will see how that one develops. Timeline, everything is on the mainnet since September 18. It's fully operational, basically, but it's not launched because the funding in the space is currently some kind of disappeared, right? Since November last year, IEOs or whatever you want to come, it's some kind of difficult to do that stuff. We will also have a card. So basically it's interesting, right? There's banks now doing that thing, stable coins I'm talking about. There is governments that use stable coins, asset managers like us not doing stable coins. There's a huge inflation in regards to stable coins, but we have been the only one with government bonds. So bear this in mind if you read about us. You heard that the first time here in Malta. This is it from my side. Thank you very much for the attention and good time in Malta. Cheers. I give this to you. Okay, thank you. Hi, Brad.
Yeah. We are ready? Okay. So we're behind schedule, so we're just going to race and leave because our time is up, but I guess we can do a couple minutes. So there's two things that are for sure. People die and people lose their wallets or private keys. And what we're going to talk about today is how these gentlemen look about the future of the security of blockchain, because that's the biggest problem today, I believe. I work for a company called KeychainX who helps people recover wallets, and this is an issue, I think, which is growing with the business. So if we start with you, Pascal, if you introduce yourself. Doesn't work.
Okay, can you guys hear me? Yes? Okay, I'll speak loud. So, hi everyone. If I do this, oh, it works. Thank you. So, hi everyone. I'm Pascal Gauthier, I'm CEO at Ledger. I always start these by, can you please raise your hand if you own a Ledger Nano S or one of our products? Malta, we can do better than that. Okay, thank you. Thank you for those who raised their hands, and for the others, ledger.com, go buy. That's it. No. So we deal in security. So we protect private keys for our users, and we try to guarantee same level of security whatever you do with your coins. We don't believe in the cold storage, hot wallet type of dilemma. We believe that whatever you do with your coins, you should do it with the same level of security. There is no state of the coins where you should put yourself at risk. This shouldn't be the case. It shouldn't happen. So,
but it happens all the time.
But it happens all the time. So when you do cold storage, meaning you keep your coins at home, and suddenly you want to do a transaction, you should be able to do that in a single move with one technology that allows security all the way through. So this is what we're doing at Ledger, and we provide services for the end users, so people that raise their hands, and also now financial institutions through a product called the Ledger Vault that we're selling in the market, that brings the same level of security but with governance on top. Governance meaning the rules of accessing the coins. If you suddenly, all of us work in a hedge fund and we need to access 100 million of coins, then who's got access to what? What are the rules of engagement? All of these things the Ledger Vault does for your company.
Okay, thanks. That was a short introduction. And Brad?
Hello, everyone. I'm Brad Yassar, and I'm here as someone who lost access to a lot of coins, as an example of what not to do. On a more serious note, I have an advisory business called Beyond Enterprises. We help companies, governments, funds with best practices in blockchain. And of course, safeguarding your digital assets is the utmost important best practice.
Malcolm?
Hi, I'm Malcolm Falzon. I'm a partner at Camilleri Preziosi, a law firm based here in Malta. I'm also a director of Kama, which is a prospective VFA agent which has been set up recently. We are advising a number of prospective ICO issuers or license applicants under the VFA Act here in Malta.
Okay, so the biggest problem today in crypto, which not many people talk about, is the security and the private keys. People lose their private keys. Exchanges got hacked. There are a problem with software that has glitches. So even though you do everything correct, like the pre-ICO in Ethereum, there's a couple of other, like the inflation bug in the Bitcoin Core software that was nobody talked about. And the solution, Pascal, what do you believe would be the solution in the future for addressing those vulnerabilities?
Well, I mean, you named a lot of vulnerabilities that have sort of like that are different things where you don't have one solution that solves them all. So we just focus on one. We just focus on the problem of the private key. Holding a crypto is holding a secret, and the problem is if I tell you my secret, then we both know my secret, and then we both know where are the coins and extract the coins. So this is the thing. And the problem is, it makes, the crypto is amazing, actually. You know, the first time I used crypto, I wire a large sum of money to, you know, someone, and I was like, wow, this works much better than my bank. But then I was like, shit, but this is very dangerous because now I have the key, etc. And so people say, oh, it's amazing, it's decentralized, I've got my coins. But like in Spider-Man, they say, with great powers come great responsibilities. And so therefore, people undermine security because they think they're going to use Bitcoin the same way they use their Revolut account. But no, and people say, oh, you know, I don't want to use a Ledger Nano S because it's clunky. I don't want an extra device. I want to do everything from my computer, from my phone. I'm like, okay, you go do that with a lot of Bitcoins. And then
so where do you keep your private key?
No, you keep your private key into, you know, what we feel is best security is what we do in the sense that it's a technology that's been proven for the past 25 years. It's based on hardware and software, and at any point, you will never reveal your private keys. So my point being, actually, I'm not here to sell Ledger. My point being is people don't understand how critical it is to assess security. As soon as you have let's say you have 100 coins, that's actually a lot of money. You should be spending a good amount of time during your day to know how to secure those coins. And if you want to keep the coins, you need to spend time and money to actually secure the coins. You need to have a safe, you need to have a deposit bank. I mean, there needs to be something around that makes the coin safe. And it's not just you, and if you go under a bus, then the coins are gone.
So what's your solution for the future? What does Ledger has in the pipeline?
But there are a few things. There is security, and so Ledger is a good place to start. You can have the Nano S, but then the question is, if only you has access to the Nano S and not your wife, for example, it doesn't solve the problem. So you need to understand what your governance is going to be on the coins. And if you give access to your lawyer, if you give access to you know, anyone you trust, to your wife, and you can have double signature, multi-signature on one address. My point is my point is, number one, there is not one magic trick that solves the problem. It's not because you have a ledger that actually your problems are solved. It's a combination of different things, but the fundamental understanding that security is at risk, and if you own your private keys, you need to spend a good amount of time to understand how to manipulate this, to understand how to keep them safe, and to understand what to do and not to do when you make a transaction. I give you one example and then I shut up. If you're about to transfer 100 coins, or whatever the coin is, but let's say 100 Bitcoins, don't do it in one go. You know, you transfer 0.0001 to just validate that it's the right address. You call the person that you're going to send the coin to, and then you make the big transaction. So typically something like this are good practices. If you come on our website, we have a list of all good practices that we recommend. Yeah. But that's not technology, it's more process.
Okay, Brad, you said you recommend governments or businesses. Like, what's your take on the future of storing crypto safely?
Well, I think we need a paradigm shift from starting with a seed phrase or words that need to be kept somewhere, whether it's in a safe or memorized in your brain, and move to a more harder to duplicate or discover method of starting point. Because once your keys are created, both public and private, obviously that allows you to have a certain amount of access to those assets. If you start with a 24-word key, those 24 words are some combination of words that other people can guess or figure out or even copy from where you have it. If you start with something different, for example, biometrics. If you start with a biometric seed, or
is there a solution today that you know of that does that?
Yes, there are a few companies working on it, on the iris movement encryption. There's a company called Iritech that tracks the movement of your iris, which is much more harder to copy than just an image of your iris. And if you start with a seed like that, then it doesn't matter if someone has your keys, because they can't access the funds without unlocking your wallet. So if the unlocking mechanism is you, or we were discussing earlier, a geometric approach where you have to be in a certain location to unlock something, then the leakage of keys becomes less of a problem, because they're not where they're supposed to be, or they're not who they're supposed to be to access those funds. So I think we need to it was a great start to start with a very strong encryption on words and phrases and keys like that. I think we need to move towards more of an individualized approach, where even if my keys are discovered, if I'm not there, they're not accessible.
So actually, when you said this guy, so what's the mark on the legal aspect? If I find a ledger, can I claim finder's fee?
Well, there is
like, I mean, if I find a wallet, I can claim 10%, right?
I'm not sure about the percentage. I mean, there is this old there is this old provision in the civil code relating to treasure trove, which would potentially apply in the circumstances. But I think we're talking about an ecosystem here which was definitely not around at the time that particular.
So what's the
provision
treasure
was
trove on the blockchain? I mean, there is how much? 20% of all the crypto is lost or forgotten, and like the famous Silk Road wallets, which are 3 of them, 65,000 Bitcoin each. If someone happens to open them up, do they have like? What's the legal aspect of that, in your point of view?
I think the legal aspect of that, well, I mean, speaking specifically about from the Maltese law angle, I think the local law focuses specifically on what should be done in order to avoid the prospect of actually someone losing and then someone else finding that crypto, and that I'd rather focus on that rather than speculate on something which at this point in time I don't think is covered by the regulation. I think the point to make, and coming back on the points made earlier, we talk a lot about the practical solutions, the practical defenses that we can that service providers can take in order to prevent these things from happening. And I think what Malta has done in drawing up its Virtual Financial Assets Act and setting out certain requirements for service providers, including custodial wallet providers, is that of creating requirements which will ensure that you are continuously doing your job. As Pascal was mentioning, you have a responsibility.
But let's say I have a wallet, right, a ledger, and the ledger is connected to a computer which has a piece of software. It's not the hardware, and there's a glitch in the software, and it happens all the time that it's a byte flip, and when I send it, it's going somewhere else. So in point of view, who's in trouble?
Glitch in which software? If it's ledger software, it's one thing. If it's
I'm not talking about ledger
if it's
software.
the protocol, it's another thing. Eh?
But I mean, you have a online site like My Crypto or My Ether Wallet where you can connect your ledger, and if they make code something error, and you type in your PIN on your ledger and you send it to an address that you see, it's the one, but the receiver is something else.
Yeah, without wanting to sound like the boring lawyer, I would say, try to break it down and say that there are two relationships here. I mean, there is that between you and your software provider, and that between you and your client. And I think between you and your software provider, you would need to establish whether in that relation there is the prospect of being indemnified for the results, for the consequences of that glitch, which have not occurred as a result of your wrong application of the technology or of your negligence. And then there is obviously the recourse that the client could have to you as his service provider. And again, we'll go back to the point made earlier about what means can be taken in order to protect yourself in that position. So things like crypto insurance, taking out a professional indemnity insurance, both of which are aspects which have been codified in our law as requirements for those who are holding custody of assets.
So one of the things I'm interested in is there any biometric plans for Ledger in the future to use that as storage of your private keys or as a seed?
No, not really, but to double down on what you just said, I mean, I think for me it's not a technology problem. I mean, it's not only a technology problem. I know there are a lot of developers in this world and they're doing like hard technology, but coders are not building product, they're building code, and then we need to build products. And products is a combination of the code, it's a combination of, like you say, insurance, regulation. I mean, especially if you think, you know, whether you think for the individual or you think for a financial institution, it's not just the piece of code and the HSMs that you're going to put in some data center. It's just like everything that is around the custodian in terms of regulation, in terms of insurance, etc. That's going to bring security because, you know, in this world there will be glitches. There will always be some kind of, you know, hack. People will try to steal money, like they're stealing money from the banks today through credit cards. I mean, credit cards bleed, you know, hundreds of millions of dollars every year. It's no problem. It's insured, and but it's you know, it's a business that is because it's insured, it's okay. And so if someone takes your credit card, they can easily steal money from your bank account, but you're okay. So it's not the problem of not losing coins or not being hacked, etc. It's the problem of what is the overall infrastructure, what is the product. And sometimes the industry gets it wrong when we feel that it's just building technology, because building technology is not the product is something else. So we need to build a product, and it takes lawyers, it takes you know, financial people, it takes CEOs like me. I'm not a technical guy, but we're building products.
So Brad, any final words?
Well, I think, again, I'm a big fan of Ledger, to put it out there. They've done an amazing job technologically. And as far as final words, of course, it's the whole ecosystem. It's the experience. So if the experience is just based on one hardware that you only have access to, just like Pascal said, and you lose that access, well, that's not a good product overall. The hardware may be perfect, the software may be perfect, but the user experience isn't. So we need to evolve it to a more user-friendly model. But as far as security goes, again, I think we can change a little bit how we seed the wallets and make them much more difficult to just duplicate or copy just because of additional measures. And I'm sure, you know, it's not just going to be a hardware solution. It's going to be more education on how people interact with their devices and what the environment is, both legally and commercially. Obviously, if I can insure all my hardware wallets, that's a much different experience than just having to safeguard them myself. And we're moving in that direction.
Okay, thank you very much for coming.
Thank you, everyone.
Come on. Thanks.
Am I on? Does it work? Fantastic. All right, so I'm going to talk a little bit about how to improve fintech in general within the blockchain space. And this is very much experience-based. I'll share with you a little bit about my history. The core topic, of course, is are trust layers and increased efficiency enough for mass adoption? Because this has been the claim to fame for blockchain, right? We are creating trust layers, but are they enough? Is just having more transactions per second enough? And what are we doing apart from that to really make it work? That's a little bit about me. Just so you know who we're talking to, so I'm the CEO of Close Cross. We do collective prediction markets. That's not what we're going to talk about today. 99, I launched my first digital currency. 2007, I wrote the paper on financial decentralization that formed the basis for the patent application to the United States office in 2008, which was granted to us in 2011. Now, in 2018 is when we launched the testnet for what we're doing. I'm not selling you anything. I'm not doing an ICO, so this is really just experience sharing, right? Trust layers. Blockchain has given us this as the single biggest benefit that we can have. Right? Everything is open source. You can examine everything. There is true transparency of everything. Everything is decentralized at the infrastructure level. Well, in most cases, except some of the blockchains. And this has given us a very valuable resource. Right? This is all about delivering trust to the end users. And this has worked great because now people are doing it. What has this done? This is a great value system fit. Today's users and today's consumers and tomorrow's growing population is essentially thinking in a completely different way. This has gone from in God we trust to in code we trust, right? And you've heard this many times, but this is actually happening. People are saying, I do not need to trust one person or one institution. I rather trust the whole mechanism as a whole because it now gives me all the benefits I can have without having to put my trust into a single party, right? And that's great. That's fantastic. So now we can deliver trust to everyone without anyone needing to trust us personally because they're trusting the system. They're trusting the blockchain effect. They're trusting the consensus environment. They're trusting the decentralized authentication mechanisms. Now, the next thing you have to do when you talk about delivering fintech in the blockchain spaces, can we do it at scale? So you must have heard in the last 36 months a lot of comparisons being made to a lot of different existing centralized institutions. The number that was quoted the most was, how many transactions per second can Visa make? Does anybody know how many can they make? 24,000, and that was supposed to be the benchmark. And they said Bitcoin and Ethereum cannot match that. Until we match that, we will never be able to deliver the efficiency we can for everything that we want to enable around that blockchain environment. Then what happened? We got the Lightning Network. Now they claim we can do 1 million transactions per second. So we're solving for that as well, right? So we're no longer waiting for a transaction to go through. Well, some of the platforms today you're still waiting. But if adopted correctly, we're no longer waiting for things to actually happen in the financial markets. So that also we've solved. And my question is, are just those two things enough? Because this is what everybody's been talking about for the last 36 months. I'm not sure is the answer, right? What are we really after? Everybody says we want large-scale disruption. We want to change everything. We want a revolution, or we want a paradigm shift, right? There's everybody dreaming about a brave new world that can be accomplished with the new technologies that we have at hand. But creating the trust layer and making it efficient and having more transactions processed is probably not going to make it happen. Why is this the case? So if it would go to the next one. There. What we are saying is disruption may be tech-enabled, but it is still always led by the people. We have great technology at hand, but until the people are really adopting everything which we are creating with these technologies, it's not really going to make a paradigm shift. It's not really going to bring a brave new world into existence. So even in fintech, just like any other industry where consumers are the focus, we really need to put the focus on the user. The guys who you were here before talking on the panel, they said the same thing towards the end. The technology is great, but does it deliver the user experience that the user needs to have? That's exactly the point, right? Does the customer really need to make an extra effort just to understand your technology or your processes, right? Or just to connect to the other people using these technologies? You look at this woman at first sight, she looks happy, but now you look at it, the errors are all going out. We're asking this consumer to go and figure out how to handle our technology, how to work with our processes, and how they can then connect to the people. Now you see her closely enough, she's actually grinding her teeth, because this is not the user experience she wants, even though we believe that we are enabling everything with the technologies that we are putting in place. And this begs a question, right? Is it really fair for us, as the guys who are actually in this space and enabling all the different dApps and all the different platforms and the DEXs and everything else, to say, is it really fair to ask your customers to deal with sometimes complex systems and tedious steps just so that they can gain access to the trust layer which is the first promise. It probably doesn't need to be the case, right? And in some cases, is it fair to put the onus on the users to say, you need to make sure that you are compliant, but I absolve myself from everything because I'm only providing the smart contract? How often have you heard that? We are a platform of smart contracts. Now, consumers who might actually be using this will probably get into trouble later on when the regulation catches up and says, actually, you know what, 2 years ago you put together this thing, which was probably not something you were allowed to do because you're not regulated to do that. So we need to think about the consumers, right? It's great to create technology base, but if you are putting your customers at risk, even in the future, then perhaps that is not the right way of doing it. This is why maybe some people are staying out, because they're not sure if they will get in trouble by using these technologies. In some cases, the users are actually taking on potential counterparty risks, which is not allowed in any industry, in any regulatory environment in the world. But this is happening. So we need to take care that even when we are doing a revolutionary application or a platform, that this is not the case, right? This is where we need to focus. So the question we need to ask ourselves, and there are more questions in this presentation than answers, because this is really a thought-provoking exercise, right? There are no answers which can be given to everybody. But will it really be a brave new world before we give the customers what they want, how they want, and when they want, right? The example of before. Yes, you've given them a USB stick wallet. Now they can do what they want. They can store the coins, but that's probably not what everybody wants, because they want an easy, safe way to do all those things. Or the user experience, or the security, like creating a will in a traditional asset class by saying, if I am gone, somebody else gets it. How do they get it, right? These are all the things which we will need to answer. And I'm going to use some of the quotes again, just to make sure that I get the point across. Now everybody knows who this guy is, so I'm not going to say it. But what he said was very important. Great technology should be beautiful. That's the Apple way of doing it. Or invisible altogether. And today,